a couple of the things I didn't mention that are slightly more innovative or that people forget to think about is that at the very early stages, and even into later stages, your first port of call as a startup founder or a management team is really your existing investors, sort of little exploited area of really piggybacking on your existing investors. They are the number one ambassador of the company. They are vested. They have an interest in supporting the company to raise finance. So it's not you, the startup, that leads the process. It's the investors that go and create a syndicate and raise capital for the startup. Well, I think so. Again, we need to sort of separate the two stages in different, sort of two buckets. At the very early stage, as I said, there's government-backed loans that are a port of call. There are a range of grants, both in the UK and in Europe, that startups can go after. I think the accelerator and incubator routes are tremendously valuable. So the distinction perhaps being that for an accelerator, you have a team, you have an idea formed, and you are applying for mentorship support and for joining a process and for all that exposure. In an incubator, you're partnering with a corporate to launch an innovative idea. There are a number of less well-known pre-seed VC investors, particularly in the UK, and those are interesting to approach. Some of them will invest off a spreadsheet or a one-page document that says, here's what I'm planning to do. If they believe in your opportunity and if they believe that you can achieve it, they might be inclined to back the opportunity at the very early stages with a view to then being involved in the investment rounds at the later stages. I'm sure there are more. These are just the ones I can think of right now. In the later stage, so many more opportunities open up once the company has a bit of traction, particularly if it's reached a certain level of revenues or revenue growth. So, $500,000 to $1 million plus revenues annually, suddenly there are plenty of other options that open up. Not least, obviously, bank funding and traditional loans. But there are a number of new lending models that have popped up in the recent, I would say, 12 to 18 months that are becoming increasingly popular. So, some have been around for longer, but really only took off in the last kind of year, 2 years. And these are the likes of invoice finance. So one of the better well-known ones in the UK is Market Finance, which started off as Market Invoice and is now called CRIA, provides a range of solutions based on effectively the company's business as opposed to its assets, which is very interesting for startups or companies that don't have much by way of assets. And a new form of finance, which is called revenue-based funding or revenue-based finance, which proposes finance based on your expected or your trajectory of revenues. And so these tend to fund a percentage of your annual recurring revenues, particularly if you're a subscription or software as a service business or a direct-to-consumer business, whereas invoice finance tends to focus on B2B businesses. So these are some, alternative routes to getting funding, alternative to the traditional VC route. I think an increasing force in the investment space, again, also at Series A and Series B recently, is the corporate venture capital group. So a lot of companies, particularly tech and banks, are starting to create corporate venture capital units or reinforcing their investment in corporate venture capital in order to really help push the ecosystem and get a first view into the trends that are happening and the technologies that effectively might disrupt them. And so this is well worth researching. These companies, these vehicles tend to invest at later stages. They tend to invest in propositions that are complementary or valuable to their core business or expand their core business, or into propositions that are showing a trend, a significant trend that they want to, have a part of. And so this is about looking at, financial institutions, looking at consumer companies, looking at technology companies, again, just doing the legwork and finding out which ones have corporate venture capital units, what they invest in, and whether it's a good fit. I think a couple of the things I didn't mention that are slightly more innovative or that people forget to think about is that at the very early stages, and even into later stages, your first port of call as a startup founder or a management team is really your existing investors. And people forget this. We've just worked with a company that is in the process of a capital raise, which we are working with. And as an interim measure, they've made a rights issue in order to raise, a significant amount of money from their existing investors, offering them, advantageous terms, and effectively corresponds to, a bridge to the next stage and gives them leeway so that they can be in a better position to raise the round without, being in a tight spot. But likewise, at the very early stages, intros from existing investors, or even just a sponsor to an angel group pitch can be extremely valuable. And so I think there's this sort of little exploited area of really piggybacking on your existing investors. They are the number one ambassador of the company. They are vested. They have an interest in supporting the company to raise finance. And so I think that's one area of innovation. I think you're right. These alternative financing approaches. There's also, like revenue-based finance and invoice finance, but there's also a range of new propositions that are popping up that are providing early stage companies and SMEs with insights on their financials. And many of these companies are now connecting with traditional lenders because they have the insights on the financials. So say you have, an accounting platform, and then you have these platforms that plug into your accounting, but provide forward-looking insight based on, algorithms and nifty bits of AI and so on. And so they provide forward-looking credit scores, forward-looking insights that are valuable information for banks to provide better loans or better risk-adjusted loans or better priced loans. And so these are now combining with loan origination and traditional lending in order to offer automated solutions for finance. It's well worth researching this area because it's a growth area in fintech, particularly for SMEs and growth companies that I think should be researched. So crowdfunding is another option for finance, particularly at the early stages. So, seed stage or pre-launch, but increasingly used also at later stages alongside existing investors or even alongside a VC. And there are different models, but so I'm going to focus on the equity fundraising because that's the one that's, that we're discussing here, sort of equity capital raises. But there are different models. There's traditional equity raises, where you present your company and you present the capital that you're looking to raise and you present what you're offering in exchange for that capital. So what share or what, equity you're putting on offer, and a number of investors come on board. And typically the crowdfunding site is the nominee or kind of centralizes so that you don't have 2,000 people on your cap table. But there's another one, which is precisely around syndicates, and it enables you to create a syndicate of investors, and it's led by your investors, your current investors. So it's not you, the startup, that leads the process. It's the investors that go and create a syndicate and raise capital for the startup. And there's a couple of these, both on both sides of the pond here in the UK as well as in the US. So crowdfunding definitely an area I think that's worth exploring at any stage. You can get peer funding for equity. There's also peer funding for loans and lending, later on in the life cycle of the startup. And so there's alternative lenders that are not sort of traditional bank lenders, like peer-to-peer lending and other online credit brokers that provide access to funding, particularly for short-term or for working capital funding, that enable a company to invest in its working capital or marketing or growth or whatever it may be on a sort of shorter term, in order to then achieve the growth that it's going after.